Well, my friends, here we are again. Just as things seem to be looking up for crypto investors and markets are up, something swoops in and takes us right back down to earth again. And unfortunately, this time around, there are some genuine reasons to be concerned about the immediate and midterm future of the crypto markets. In this video, I'll break down what's going on right now, what might happen next, and how to protect yourself. So make sure you stick around for the whole video and hit the subscribe button so you don't miss any crypto updates, especially urgent ones like this one here on the show. So let me set the stage for you here in this multi-act play of disaster. This week, the well-known CEO of Binance, Changpeng Zhao, also known as CZ, took to Twitter to publicly call out fellow crypto exchange operator Sam Bankman-Fried, the founder and CEO of FTX. And I'll share more about what CZ said on Twitter in a second, but you also have a third player in the game that we have to talk about first, Alameda Research. Again, Sam Bankman-Fried's trading firm with very close ties to FTX. This whole rigmarole started when reports began to swirl that an unhealthy proportion of Alameda's balance sheet consisted of the FTT token native to FTX, and that triggered a lot of concern amongst investors about Alameda's potential financial issues. In tandem with this, you have this issue of CZ's tweet storm against FTX and by proxy, Sam Bankman-Fried, which vaguely referred to some recent developments that have came to light, which CZ implied were grounds for Binance to market dump $2.1 billion worth of FTT tokens as they divested from its stake in the exchange's token. Naturally, people fearing what could surely be an FTT price plummet with this dumping of tokens started to preemptively flee FTT positions, dropping the price heftily and eliminating liquidity. Cue more speculation about Alameda and FTX. If FTT is a huge part of their balance sheet and it's tanking, what happens next? Following this uncertainty and without any clarity as to FTX's stability, a massive outflow of stablecoins and crypto withdrawals began from the FTX exchange, which fed into more fear about FTX's liquidity and ability to fulfill withdrawals. So you can see where this situation got really crazy really fast. This was in like 2 days. You have speculation about Alameda being insolvent. Then you have CZ stating Binance is going to market dump billions worth of FTT, the very token that's purportedly weighing down Alameda's balance sheet. And then you have effectively a bank run from FTX, and then withdrawals are halted. From there, the entire crypto market reacted very badly, and understandably so, because as FTX halted withdrawals, there's silence, little explanation. However, things got even crazier, as if that seemed possible at the time, because after basically remaining silent throughout all this chaos, Sam Bankman-Fried tweeted that Binance had agreed to a conditional letter of intent to acquire FTX to help them. That was literally the last thing that I and many of us probably thought would happen. So now you have FTX pending due diligence being acquired by Binance in what seems like kind of a bailout by a competitor. So how the heck did we even get here? Wasn't FTX the stable pillar of crypto exchanges? Wasn't SBF or Sam Bankman-Fried a savior? Why would they willingly go to a competitor to be acquired? So here's the speculation about how this happened. And remember, this is speculation, not fact, until we see these details confirmed, and we will. Just bear that in mind. I'm speculating. The only thing that makes sense here is that FTX was operating like a fractional reserve bank, lending out customers funds to chase yield, likely through Alameda, the trading firm, who would have used those massive reserves of FTT on the balance sheet as collateral for lending with other entities in the market, which is very bad. FTT is an exchange token. It's really not worth much. With FTT tanking, Alameda could very well have felt the sting of its dropping value and liquidity. Therefore, when the reports started to swirl about Alameda's burdened balance sheet and CZ tweets about market dumping billions worth of FTT, people are worried about FTX's stability, and the withdrawals started coming thick and fast from FTX as people sought to protect themselves. That's normal behavior because they don't know what's going on. Of course, when operating a fractional reserve model, you don't have enough funds on hand to cover every withdrawal, requiring them to try and recover funds that they may have lent out to cover withdrawals as they come in. Now, with the knowledge of the end result, which is that Binance is seeking to acquire FTX instead of any other means of making ends meet, it gives us a little bit of a hint that Alameda and or FTX might be very, very bad in terms of their financial position, and there's a big gap in funds that made other means of recovery impossible. Otherwise, there would have been far less desperate ways to make ends meet and cover these withdrawals, right? So the speculation of all speculation here is that there is a much bigger insolvency or balance sheet issue for FTX and or Alameda than we know about yet. And after the whole Three Arrows Capital saga and Terra Luna and Celsius and Voyager, the markets cannot absorb more of this. And I can tell you, if Alameda and or FTX is insolvent and that's why Sam Bankman-Fried went to a competitor for a bailout, the market reaction will be very, very painful. And it'll potentially be worse than the Celsius Three Arrows Capital contagion we had before. The exposure is bigger. But the biggest issue here is the complete lack of transparency and the fact that the investor has had no idea what's going on, what the truth is, and how to approach this whole market with the uncertainty that's gone on throughout this whole thing. There's been no communication. You know what this feels like? It feels like traditional finance, doesn't it? It feels like a silent gas leak that only shows itself when it explodes. And that's the antithesis of what this whole decentralized technology concept is all about. So what does this technology solve if we have the same problems systemically that we had before? Whether this results in Alameda, the embattled trading firm that's at the center of this, plunging into insolvency, or it's FTX, or if this blows over without major consequence, the result is the same. This whole saga is yet another huge alarm bell ringing for regulators to act quickly and aggressively to fix the problem. And anyone who pays attention to lawmaking and regulation throughout history knows that quickly and aggressively means that without the deliberation necessary to ensure that there are no side effects to policy that is enacted out of desperation. It means rushed policy. It means unintended consequences. It means bad things for crypto and the many, many good actors that there are left in it. Unfortunately, this issue of another exchange pillar falling is not the only blow the crypto markets suffered this week as well, because the decentralized video platform LBRY, I think their platform is called Odyssey, lost their case with the SEC in a summary judgment that effectively stated that the LBC cryptocurrency or LBRY credits were in fact a security by rule, and that the company is guilty of offering an unregistered security. This opens the door for basically every single cryptocurrency, arguably besides Bitcoin, to be defined as a security, which would be an unmitigated disaster. Here's what you need to know about this whole thing. LBRY created a video content platform that had a cryptocurrency, LBRY credits or LBC at the core, to incentivize the whole platform and be a payment method therein for tips and compensation. And after operating for a while, they were served by the SEC for offering an unregistered security back in March of 2021. And that's the short story of how we got here. Now the details about how LBRY lost the case, because that's the most critical. Of course, LBRY argued that they did not in any way promise token holders returns or attach the company's actions to the token in a way that would indicate that the LBC token holder could have a reasonable expectation of profit based off of the company's efforts, a critical component of the Howey test, how the SEC and lawmakers and judges determine what a security is. LBRY further argued that it didn't have fair notice from the SEC that its actions were unlawful. However, these efforts clearly failed to sway the judge in their case, and they were found to have violated the Securities Act of 1933. In reading the document produced by the judge with the result, the actual language used here in this judgment is really concerning. First, it states, I quote, "The SEC identifies multiple statements by LBRY that it claims led potential investors to reasonably expect that LBC would grow in value as the company continued to oversee the development of the LBRY network. LBRY has, at key moments and despite its protestations, been acutely aware of LBC's potential value as an investment, and it made sure potential investors were too." This makes it very clear that because LBRY did indeed enter into the territory of generating expectation of profit through LBC, it was a security. Now, this next statement is the most significant. Again, I quote, "The problem for LBRY is not just that a reasonable purchaser of LBC would understand that the tokens being offered represented investment opportunities, even if LBRY never said a word about it. It is that by retaining hundreds of millions of LBC for itself, LBRY also signaled that it was motivated to work tirelessly to improve the value of its blockchain for itself and any LBC purchasers. This structure, which any reasonable purchaser would understand, would lead purchasers of LBC to expect that they too would profit from their holdings of LBC as a result of LBRY's assiduous efforts. Simply put, by intertwining LBRY's financial fate with the commercial success of LBC, LBRY made it obvious to its investors that it would work diligently to develop the network so that LBC would increase in value. What this says to me, and clear disclosure here, I'm no lawyer, I'm no judge, is that the fact that LBRY set aside pre-mined LBC tokens for themselves as they work to grow the platform, it means that they were aligning their incentives with the end investor. Their expectation of value accrual for their tokens would reasonably lead any other LBC purchaser to believe that it would also accrue in value as well. Therefore, the contention that LBRY made that LBC was consumptive in nature to be used as payment method and a monetary instrument in their platform was moot. And this is concerning because even, quote, if LBRY never said a word about it as an investment, the result would have been the same. This could be read to mean that theoretically any token with pre-mined supplies set aside for the foundation or company building and developing the blockchain could be designated as a security regardless of messaging or the use or utility of said token or any guarantees or thoughts or things that have been discussed by the company. That would be a rough precedent. The interesting thing is that the Ripple versus SEC case is still waiting judgment, and that could very well be the one that either confirms or counters this ruling. So we're going to have to wait and see what happens with that case. And I have a video talking about that, so I'll link that up in the description if you're interested in watching after this. That said, this is a bad result for crypto, and it casts at least a shroud of doubt as to whether every cryptocurrency could be defined as a security under this methodology. We really don't know what's going to happen here, and that alone, the uncertainty, is the tough thing to deal with. So with that, we've had the first jab with CZ versus Sam. We've had the second jab with LBRY losing its case and being declared an issuer of an unregistered security. And we're just waiting for the knockout punch, which could very well be Alameda or FTX insolvency or a heavy-handed regulatory response or both. And I hope this doesn't come, but here's how you can protect yourself in case it does. First and foremost, please get every single penny you can off of any centralized custodial platform like exchanges, savings accounts, anywhere you have crypto that's not in your possession, in a hardware wallet or in a personal wallet, move it. This is a lesson you only need to learn once, and I'd prefer you don't get caught up at all, so don't get in a position where you can lose funds from a centralized platform collapsing. Move to self-custody, get a Ledger Nano X or a Trezor Model T or a Keystone wallet, and move your funds. So I'll leave links to those wallets in the description and any relevant discount codes I can find if you want to buy one or check them out. Secondly, you should avoid getting sucked into the 2023 is going to be a new bull run for crypto narrative, because I've already seen all the hopium on Twitter talking about 100K Bitcoin and return to bull run and all this nonsense that we have absolutely no signal whatsoever will materialize anytime soon. In macro and anywhere, no signals. That could change, of course, but right now nothing has changed. The market's unpredictable, the macro's terrible, there are still bad surprises like FTX and Alameda that could change everything. So be very defensive and protect yourself first and foremost. These times are hard enough economically for a lot of people, and the last thing one wants is to see their investments liquidated to nothing or lost in a centralized platform's insolvency and locked up for months and then being returned with cents on the dollar. Nobody wants that. So at the end of the day, you need to protect yourself first. This type of market, whether in equities, whether in crypto, in any investment right now, with all that's going on in the world, there is absolutely no worse time to be trading aggressively or trading with greed. You need to be defensive and you need to be careful. That is the key to this market. Now, with that, folks, I want to say thank you so much for watching this video. I know it was a heavy video, but a video that's really important nonetheless, because you need to be aware of what's going on in the space so you can proactively protect yourself. Even though some things are already said and done, there are moves that you can make to be a little bit more defensive to protect yourself a little bit. So remember, I do have a video about the Ripple versus SEC case. That's another really interesting counterpart to what happened with LBRY. So I'll leave that linked up here on the screen if you want to watch that video. But thank you so much for watching. Hope you have a great one. And until next time, cheers.